In this presentation, we will enter adjusting entries related to insurance. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're currently in the Adjusting Entries tab as opposed to the Journal Entries tab. This is typically the way adjusting entries will be done, in that we will be recording a general journal type transaction, recording the activity to a general journal, but instead of recording it directly to the GL, we're going to make up this nice little worksheet here, and it's going to give us the activity of what happens in a nice quick format. And because we're doing with these timing entries, it's really useful to do that. So in other words, if we go back to the journal entries, what we've done here is we've said, okay, it's the end of the month. All the normal journal entries have been entered up through January 31st. That's what normally happens with the adjusting process. We've got the trial balance, which we typically just call the trial balance. But when we go to the unadjusted trial balance, we take this trial balance and then rename it as unadjusted, meaning we haven't done the year end or period end or month end, in this case, entries to make it as close as possible to an accrual basis before we then make the financial statements from it. So all we're doing is taking this number as our beginning numbers, going to the Adjusting Entries tab, and you can see in the formula here, we're just taking the same numbers, so that's going to be our starting point. Now, why would we do this? Why don't we just enter it into the General Ledger 1? Like we said, it's easier to see, so it's easier for us to work in this worksheet and make sure that our accounts are exactly right. And the reason we don't do that normally on the normal journal entries, why do we have a general ledger in the first place? Why don't we just have this middle column? This middle column doesn't give us a lot of detail. For example, if we had a lot of transactions. So in other words, if we had a lot of activity to accounts payable or accounts receivable here, then we wouldn't be able to see it with just this one column. It would only be one number representing a bunch of journal entries. But if we only have one journal entry that's going to be affecting a few of these accounts or a couple of them, then this one column worksheet works really well, because it'll show us here's where we started, here's the one journal entry that affected this account, and here's the ending point. So when there's few journal entries, a setup like this, very helpful for us to do. We will, however, have to put it into the normal system at some point in time. We won't do that in this problem, because we're not going to go back and do the journal entries here. We're just going to move forward to the financial statements and closing process. Just note that if you're working in a database system, you would have to then take this unadjusted trial balance, probably do it outside in an adjusting worksheet, or possibly have an outside CPA firm do the adjusting process, and then take those entries that we make and put them into the general journal entries just as we would, post them into the GL, making sure that our end result, it matches the adjusted trial balance that has been generated through the worksheet. Okay, so let's go through this problem. We're going to do with insurance. Now note that with the adjusting entries, we can kind of think of a set of rules that are different just for adjusting journal entries. And if we go through those, we can know exactly what we're doing, or we can figure out what we're doing without even knowing why we're doing it. And then we'll talk about why we're doing it. So here we're going with the insurance. Insurance, all adjusting entries will typically have one account on the balance sheet above equity, above the blue line, one account's below equity or on the income statement below the dark blue or below the light blue or in the dark blue. And all income statement accounts typically only go up. So if we know those rules, and the reason that's the case is because it's a timing thing. So that means there's got to be a timing account involved, which are going to be income statement accounts, and we have to have a balance sheet account here in order for us to be dealing with these timing issues. So that's what we're going to do, and we know that these must go up because revenue and expenses only go in one direction typically. So knowing those rules, we can basically figure out what we're going to do on these adjusting entries. Note as we go that sometimes when we do the adjusting process, we have also things that happen, like we have to correct errors or do things that are not really exactly adjusting entries. They're not part of the plan. They're just things we do that we catch or we're going to fix at the same point in time. So we need to make a distinction between what is an adjusting entry. One adjusting entry is a timing entry that typically has a balance sheet and account and an income statement account, at least one. And if we do some other types of adjustments at the year end that, for example, are just adjusting balance sheet accounts or replacing something on the income statement, say we posted something to wages and it should have been in utilities, Those are kind of fixing errors. We might do them at the same time, but they're not an adjusting entry per se, because adjusting entries are planned part of the systems typically that have to do with timing. So it doesn't mean that we made an error over here to do the adjusting entries. The adjusting entries are just part of the process. So if we apply that, then we're going to say the balance sheet account up here is going to be insurance, prepaid insurance. So if we have a trial balance, that becomes easy to kind of see. So I'm just going to make that, I'm going to put my cursor right here and make that yellow right next to it. We're going to be dealing with that account. And then down here below the equity, the income statement accounts, something with insurance expense. So I'm just going to highlight that. And we know that the income statement account is going to go up. And all income statement accounts, or all expense accounts, have debit balances, and they go up by doing the same thing to it, another debit. So then we know that insurance expense is going up. So we're going to right click and copy that. I'm going to put that on the top. Journal entries are all going to be as of 1/31, the end of the month. That's the date of our financial statements. Right click and paste 1, 2, 3. So again, without knowing anything else, I know that. And, you know, just by the fact that we're dealing with insurance and it's an adjusted entry. And then the other side is going to be this one, of course. And if we debit this one, we're going to credit this one. So I may not even know the dollar amount yet. That'll take a little bit more calculation, but I know we're going to credit this one if we debit the other one. So I'm going to copy that, right click and copy. Put that on the bottom in C6, right click and paste. 1, 2, 3. Then we'll indent, go into the Home tab, Alignment, Increase Indenting. Then we just need to figure out the amount. Now, we put this on the books and said when we did this, and in practice, of course, we would look at the terms of the insurance policy and say, when did we pay it? What time period does it cover? How much time has passed? We said that we had a year's worth of insurance here that we paid for in this problem, and we bought it in January. Now, we bought it like in the middle of January, but we're going to like pretend or assume that it covered, we made that payment in order to cover all of January. So this insurance was a 12-month insurance policy covering all of January. We put it on the books as an asset because it had not yet been consumed. We still have 11 months left, but we've consumed 1 month of it. And therefore the expense, we need to record the expense related to what we've consumed for that cost, 1 month of the insurance. So 1 month would be 12,000 divided by 12. So we're going to take that here, we're going to put that here with a formula equals 12,000 divided by 12 months, or 1,000. So, and then the credit's going to be the same, of course. So I'm going to put negative of that number and enter. So there's going to be our journal entry. Let's post it and see if it does what we think it should do. What do we think it should do? It should bring prepaid insurance down to 11 months, because that's what's left, right? If 1 month is worth 1,000, and it was a year and we got rid of one, then we have 11 months left. Should bring that to 11,000, and it should bring expenses up by the 1,000 consumed, and bring net income down by the 1,000 that we have consumed for an expense. Okay, so let's do that. So here's the insurance expense. If I scroll down, here's insurance expense. We're going to put it to the middle column, the adjusting column, column I in cell I-24. We will say equals. Scroll back up just a bit, and we want to pick up that 1,000. Once we say enter, it's going to bring this account up, put us out of balance, bring net income down. So there we have it. And notice typically all of these are going to affect the income statement. So until we do the adjusting entries, we don't really know what net income is. So we have to do these, and they could affect net income significantly, which is why we have to do them before making the financial statements and making decisions upon these numbers and the financial statements. So then we're going to record the other side, prepaid insurance. Here it is on the journal entry. Here it is on the trial balance. We're going to be here in cell I9. I9, we will say equals. Point to the 1,000. We're going to bring that 12,000 debit balance down by the 1,000 to 11,000. So there it does exactly what we would think. It brought the prepaid insurance down. We're going to consume the 11,000 next for the next 12 months and not have to pay any more money. As we do so, we will continue to expense it as we use it. Note the effect on net income makes sense then, because if we're comparing January to February, we should not have insurance expense of 12,000 simply because we paid it in January as compared to February lowering our net income to almost nothing. What we should have is say, hey, we're allocating 1,000 to January, we'll allocate 1,000 to February, because those months are really consuming the same amount of insurance coverage in order to help generate revenue, and this net income represents our performance, and therefore we want to be fair to February and January. We want to be fair to January. We don't want to lower it just because we happen to pay the insurance that month, because that will not be a good comparison. For more accounting information and accounting courses, visit our website at accountinginstruction.info.